Hello everyone, welcome back to Upside Down Data. Today I want to talk about Bitcoin and what we might be able to make of its recent volatility. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you've been following the markets, you probably noticed that we've been having quite a roller coaster ride with Bitcoin. You know, we get these massive candles to the upside, which have then been followed by these massive candles back to the downside. And we've largely just been going sideways, even though there's been quite a bit of volatility in the middle. So what I want to talk about today is a couple metrics we can look at to give us a perspective of what might be going on and give us some idea of, is this volatility meaningful or not? So where I want to start is our trend confidence indicator. This is a model that we have here on the channel that is basically designed to tell you how confident can we be in a given trend, and should we be leaning bullish or bearish. So essentially what this model, the way you can read it, anything above 0 is bullish, anything below 0 is bearish. And essentially this model will look at whatever trend we're in, and then it will say, should we be leaning bullish or bearish? Can we be confident in an uptrend? Should we be doubting the uptrend? Can we be confident in a downtrend, or should we be doubting the downtrend? So essentially with the TCI, if you're in an uptrend and it's green, that's good. That means that we can be confident in that uptrend. But if there's an uptrend and it turns red, that's bad. That means that that uptrend might be coming to its end. And then vice versa. If we're in a downtrend, but then we flip green, that could mean that that downtrend is coming to an end. And then, of course, if you're in the uptrend and it flips red, that's a bad thing. So recently, what we've seen is that, you know, ever since early February, really, the TCI has flipped green. It's been saying that this looks more like an uptrend than a downtrend, and it's stayed there ever since. You'll notice we haven't had a close in the red ever since early February. So even with the really horrible events that have been going on in Ukraine and all the fear that entered into the markets as a response to that, we still didn't actually even dip down into the red zone yet, suggesting that even with all this volatility, TCI thinks that it's more likely than not that being bullish here is the more warranted response than being bearish. Now, one thing that's really nice about the TCI is that we can pull out the exact price level that it's watching in terms of that dividing line between bearishness and bullishness. And that's currently sitting at 37.6K. Now, obviously, you can take this exact value with a bit of a grain of salt because, again, this is a continuous measure here. So it's about kind of continuous confidence. And so being right at 0 is not really especially great. So even if it's green and just above 0, that's not really all that meaningful. You'd want it to be a little bit higher before getting more confidence in that uptrend. But certainly, we're not there yet. You know, we're trading above this value. And I think what's interesting to note is that kind of overall, we've been kind of setting in higher lows on the TCI down here, which might be a good thing. That means that kind of it's overall in an uptrend in how confident it is in the trend. But of course, we have to watch this carefully, right? Because if Bitcoin decides to just nuke down to, 34K or something, that'll invalidate this and this will flip red. But for now, as long as we're staying above this level, the model thinks we have more reason to be bullish than bearish. So I'm personally watching this level very closely, kind of generally in the 37K range. That's one metric that I'm watching, and the TCI still has a bullish outlook, although it's a bit tenuous, right? It's not like we're clearing well above that in an especially safe place. We're kind of coming back down to this critical level. Let's talk about some other metrics that are interesting to watch. So right now I'm on coinoptionstrack.com, and this is an interesting metric that I like to watch that looks at the options market around Bitcoin. So what this is calculating is something that's called the point of maximum pain, or the maximum pain price. And really the idea with this is that in the options market, you always have two parties, right? The people writing the options and the people buying the options, or the puts being the opposite of an option. So option is that you're betting on the price to go up. A put is you're betting on the price to go down. And then options and puts have strike prices where wouldn't be in the money, as it's called. The option wouldn't be worth anything unless the price gets above a certain price for options or below a certain price for puts. And essentially what this value is calculating here is, at what point are the people writing the options and the puts in maximum profit? So basically, if price is at, in this case, 39K, that means that on average, the people writing the options or the puts are in maximum profits. It means that the most possible options and puts will be out of the money. And the idea here is that oftentimes the people writing those contracts, the options and the puts, tend to be kind of market maker types, people with a lot of capital to throw around. And so they're incentivized to keep price near this maximum pain price, because that's when they're going to make the most profit from having written those options and the puts. Because again, the people writing options or puts get a premium. People have to pay. It's kind of like, think of it as like a down payment to be able to take that contract. Then they can only make money of it if they get beyond the strike price. And that's what these bars here are, the strike prices for the options of the puts. So really kind of the long and short is that you can look at this as being kind of like a magnet for price, that all else being equal, if there's not a whole lot of extra demand or supply just being dumped on the market for other reasons, then if there's kind of a low liquidity environment, not really a whole lot going on in the market, then these kind of larger players are incentivized to try to push price towards this value, because that's when they'll be in maximum profit. So oftentimes if you just watch the price, you'll notice it tends to gravitate towards this level, that there's nothing else crazy going on in the market. Those players can sometimes push price down to where they need it to be. And so I think this is important, because again, we're trading right now at just under 39K. Look where the max pain price is for tomorrow, for options and puts expiring tomorrow, 39K. And so that's what is kind of important to watch. Now, this is a dynamic value, and so when you start projecting further into the future, it will be changing as kind of more options and puts get written, etc. But it's just useful to look at a more short-term time frame, see what's going on in the options market and where kind of its center of gravity is. Because again, this won't save you if there's a sudden massive dump, and certainly it won't be able to predict if there's a massive pump that happens, a ton of demand that floods in the market for some completely different reason. But kind of all else being equal in kind of a more humdrum market, you often will notice that price gravitates towards this level. So I think it's just interesting to note that right now we're at 39K being the maximum pain price. And who knows, all else being equal, maybe that means we'll be able to hold that TCI critical level, that 37K range, if we know that at least there's some market participants, potentially bigger market participants, who are motivated to keep price above there as well. So just something that's, I think, useful to watch here. Now, another metric I want to talk about, which is interesting. So here I'm on chainexposed.com. This is a great website that has a ton of on-chain data about Bitcoin that's freely available. So I recommend checking it out if you're interested in seeing some of those. And one of the metrics that they have on here is this whale accumulation heat map. And so essentially what this is looking at is wallet sizes and what wallet sizes are accumulating or distributing. So, you know, whales being defined as these larger wallets, ones that have more Bitcoin in it. I'm not sure the exact cutoff that they're using here. They don't give that information exactly what they're looking at, but essentially however they're defining whales, it's looking at basically the 3-day moving average of the 7-day change in whale balances is essentially what this metric's looking at. And so then blue levels are when whales are not accumulating, when they're likely distributing. And then the red values are when whales are heavily accumulating. So it's just looking at whale behavior. What are the big players in the market doing? Now, one thing that's a little bit you have to keep in mind with these kind of metrics is that, you know, it's unlikely that all whales are just keeping all of their Bitcoin in one wallet. There are probably a lot of big players who actually spread their Bitcoin out amongst a bunch of smaller wallets, so they might not be accurately captured by a metric like this. But at least for whales that are kind of readily identifiable by having large wallet sizes, we can identify it here. And what you'll notice is that kind of more often than not, whales tend to distribute around kind of these topping out points and accumulate towards kind of these bottoming out points. And so you can think about it as if whales are distributing or not accumulating, that's generally a bad sign. If they're accumulating, that tends to be a good sign. Price oftentimes will go up from there. And so what we can notice is that whales bought quite heavily in the bottom that we saw in January. You can see this getting quite red, not as deep red as we've seen in the past before some big explosive moves, but still quite red. And they kind of accumulated through this range, and then they kind of slowed down and stopped throughout February. It was kind of moving more into the blue zone. But you'll notice that we are shifting back more into the red zone, suggesting that more whale wallets might be accumulating. Now, of course, just 2 data points is not really too much to extrapolate from. You'd like to see this become a trend like we saw here, where especially you like to see the colors get darker and if there be more of them. But this could potentially be a turning of the tide. And this is something that you just have to watch, right? Because this could easily flip back to these blue levels. So this is not decisive by any means. But certainly if we were to see behavior more like this, maybe that suggests that more upside can happen. But even though we saw whale accumulation through this range, it wasn't sufficient to really break us out, right? And then whales were largely not accumulating after that. So it's not to say that price has to explode immediately when whales start accumulating. But certainly you'd want whales to be accumulating versus not, right? If these are people who likely have a lot of capital, or entities that have a lot of capital to put into the market, you want them to be net accumulating. You don't want them to be distributing or just sitting on their hands. You want that kind of volume to come in. Because really in these kind of situations we're in right now, where the market is bearish, there's not a lot of retail interest right now, it really is largely going to be these bigger players that are going to be the starters of a rally. It's not going to be that we're going to get this random surge of retail interest, most likely. That's just usually not how it happens. You kind of need to get the hype cycle going for retail to really come in and then set us off into a parabolic run. Usually these moves to the upside are often more whale driven. And you can almost kind of see that here, where it's really whales heavily buying in before this big parabolic run, where likely the FOMO from retail started in a little bit later. And so that's what you might want to see here, is really kind of whales start driving up the price, and then retail might FOMO in and push the price even higher. So that's just why I like to watch metrics such as these, that even though you have to take it with a grain of salt, because we're not necessarily capturing all the whales by looking at it this way, and, you know, who knows if prices immediately going to explode once whales accumulate, but it's just kind of one thing on the checklist that you'd like to see, right? That if you're kind of putting on the checklist for things to move to the upside, you'd like whales to be accumulating, and then you'd also like that in confluence with a bunch of the other metrics that we watch. So just wanted to point this out as being another thing. Be watching this in the coming days to see if whales continue their accumulation or if this is just a random blip. Alright, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the TCI and the UDPI and all the metrics we look at, we're all going to make it.